In the 2020s, billions of venture capital dollars flooded the direct-to-consumer space. Companies prioritized revenue, operating under a strict mandate of growth at all costs. By 2023, that venture funding dropped by 97%. The capital dried up because the underlying business models were mathematically broken. Brands routinely paid more to acquire a single customer than that customer actually contributed to covering fixed operating expenses. They bought scale by selling at a structural loss. Top-line revenue acts as a vanity metric. It hides severe liquidity crises, making it a highly dangerous target for scaling businesses. This diagram of a standard profit and loss statement illustrates how the design artificially draws executive attention to the massive gross revenue figure. When you strip away that top line, you expose the metrics that dictate survival: contribution margin and operating cash flow. Contribution margin is the net selling price minus the variable costs to deliver each sale, things like product, freight, and fulfillment. It represents the actual financial fuel generated by an individual transaction. Shifting executive focus from gross sales to the contribution margin is the mandatory first step to architecting a financial system capable of surviving exponential growth. This split screen compares Biz A and Biz B. Both sell a product for $100. Biz A boasts a better marketing efficiency ratio, but deducting variable costs like air freight and inefficient packaging leaves Biz A a fragile $12 contribution margin, while Biz B retains $35. Assume both companies must clear a fixed operating expense threshold of $100,000 to keep their doors open. Despite higher revenue, Biz A fails to break even, posting a $40,000 loss. Biz B clears the threshold easily, generating a $40,000 profit. Efficient marketing means nothing if unit economics are broken. Contribution margin provides the only viable fuel for scaling operations. But even with a strong contribution margin, scaling will stall if management relies entirely on historical accounting data. Traditional accounting records past transactions for strict compliance. Financial planning and analysis, or FP&A, maps out future financial scenarios to guide strategic decisions. This architecture diagram illustrates the structural pivot, the fund framework. Transitioning to a robust FP&A architecture requires this new dynamic layer, which stands for forecasting scenarios, utilizing cash, navigating lean budgets, and disclosing strategic insights. While accounting tells a founder exactly what happened yesterday, an FP&A system driven by the fund framework provides the operational foresight to navigate tomorrow. Yet FP&A often stumbles when relying on blended balance sheet metrics, like days sales outstanding. Days sales outstanding, or DSO, measures the average number of days to collect payment after a sale. Because it's a blended average, it completely masks individual delayed payments, hidden credit risks, and the true cost of the order-to-cash cycle. Rising accounts receivable might look like growing sales, but it actually represents trapped liquidity and increasing operational risk. Operations must shift away from tracking blended averages. Analyzing granular, transaction-level data is the only way to uncover true customer payment behaviors. Relying on blended accounts receivable averages creates a fatal blind spot. It hides imminent cash crunches behind seemingly healthy balance sheet assets. This matrix visualizes the operational solution to that KPI blind spot, the 13-week cash flow forecast. This 13-week window, representing one fiscal quarter, balances long-term trend visibility with short-term prediction accuracy. It utilizes the direct method of forecasting. Instead of making broad assumptions, it maps actual expected cash receipts against exact operating disbursements. Unlike the rigid, static nature of an annual budget, this bottom-up model rolls forward week by week. The 13-week model acts as a real-time radar. It translates transactional data into a predictive tool, detecting liquidity crunches before they hit the income statement. Powering the 13-week model requires inputs: the beginning cash balance, transactional customer receipts, and fixed operating disbursements. Entering this data manually across disconnected spreadsheets introduces critical delays and fatal calculation errors. This updated matrix shows how modern FP&A models solve this by using API integrations. These application programming interfaces pull real-time transactional data from enterprise resource planning systems, or ERPs, directly into the forecast. With automated, real-time data, finance teams can run rigorous scenario planning. They can simulate best, worst, and base case assumptions to ensure cash survival. Automating the 13-week forecast strips away tedious, backward-looking accounting chores, transforming the model into an agile, early-warning liquidity system. Scaling a growing business demands execution on two fronts simultaneously, maintaining unit profitability while seamlessly managing operational liquidity. Contribution margin dictates if the business model actually works at the unit level. The 13-week cash flow forecast determines when the company will have the capital to execute that model without relying on external funding. By abandoning vanity metrics and adopting these two pillars, the finance department evolves from a passive reporting function into an active strategic weapon. Sustainable exponential growth is never an accident of top-line revenue. It is the deliberate result of rigorous, forward-looking financial architecture.